Hello and welcome to our new video. In this video, we are going to perform some fundamental analysis of the Apple company. First, let's take a look at the income statement for Apple. All of the figures in Apple's financial statements are in billions. The first thing we do is work out the gross margin. Gross margin is calculated by subtracting the cost of sales from the total revenue, then dividing that figure with the total revenue. As you can see, the last 3 years have been around 44% gross margin. We like to use the pre-tax income figure for our calculations. This is shown on the income statement as income before provision for income taxes. With that in mind, the next figure we work out will be the pre-tax margin. We do this by dividing the pre-tax income by the total net sales. As you can see, the last 3 years have been around 30%, which is a great pre-tax margin. Pre-tax margin is a measure of sales that has turned into profits, or, in other words, how many cents of profit the business has generated for each dollar of sale before deducting taxes. Next, we'll work out the pre-tax multiple. This figure is similar to the price-to-earnings ratio, but uses the pre-tax figure instead. The multiple will give us an indication of how cheap or expensive the stock is trading for at present. To work out the multiple, we first have to work out the pre-tax earnings per share. To do this, we divide the pre-tax income figure by the diluted shares outstanding, which works out as $7.19 per share of pre-tax income. Next, we take the current stock price, which is $227 per share, and divide that by our pre-tax income per share of $7.19, and we get the pre-tax multiple of 31.57. The pre-tax multiple is a measure of how many years of pre-tax profits it takes to recoup an investment in the stock. So we would have to hold the Apple stock for 31.5 years to regain the initial investment into the stock. 31.5 is a high multiple and would rule out an investment in Apple at the current stock price. We would like the multiple to be at least under 20 and ideally closer to 12 to 15. The last thing we look for on the income statement is the shares outstanding figures at the bottom of the sheet. This is a very important figure for us. We like this figure to be decreasing every year and would likely rule out an investment into a company if the figure is increasing. If the shares outstanding is decreasing every year, it means that the company management is buying back its own stock. When the management reduces the shares outstanding, it makes the shares we own more valuable. The reverse of this is also true. If the management are issuing shares and increasing the share count, this would make the existing shares less valuable. To summarize our analysis of the income statement, we first worked out the gross margin, which is the percentage of a company's revenue that's retained after direct expenses, such as labor and materials, have been subtracted. Then we worked out the pre-tax margin. These are both measures of profitability, so the higher the figure, the better. After that, we figured out the pre-tax multiple to analyze if the current stock price is at a level where we can make an investment or if it's trading at too high of a multiple. Then we looked at the shares outstanding figure, which we like to be decreasing every year. Thank you for watching our video on the income statement. Next, we will be looking at the balance sheet. See you then.